If you've ever upgraded or replaced a roof, an HVAC, or remodeled a kitchen in your rental property, you may have thrown away thousands of dollars. And here's the kicker: you can't fix it, not by amending, not with a 3115. Once that year closes, that deduction is gone forever. This is one of the most overlooked, misunderstood, and underutilized real estate tax strategies in the entire IRS code, and it applies to every real estate investor. Forget the sexy loopholes like the short-term rental loophole, rep status, bonus depreciations. Those are one-year fireworks. What I'm about to show you, it's a wealth compounding strategy that applies to everyone and not just the elite investors. Let me start with a story. Let's call him Mike. He was wasn't a client of ours. He came to us. They had 6 single family rental properties. Great guy, very smart, diligent, and organized, but he came to us frustrated. He said, "Anthony, I'm doing everything right, but my taxes keep going up every single year." And then we looked at his depreciation schedule and we found that he had 3 roofs on one property. He'd have replaced the roofs twice, but each time his old CPA just added a new line for the new roof, and they never removed the old ones. That meant when he sold that property, he would end up paying recapture on those 3 roofs, 2 of which had been in the garbage several years earlier. We pulled up his schedule and I said, "Mike, congratulations, you officially own a house with 3 roofs." And he didn't know whether to laugh or cry. That year was when he had replaced the most recent roof, and we were able to apply a partial asset disposition and got him an immediate $19,000 tax deduction that year and saved another $7,000 in future recapture. If you own rentals and you've replaced anything like a roof, an HVAC, flooring, electrical, that would be capitalized, this same mistake is probably sitting on your return right now. So what is a partial asset disposition? A partial asset disposition, or PAD for short, lets you write off what's left of an old component like a roof the year that you replace it. Let's say you buy a rental for $500,000 and $400,000 was a building, $100,000 of that land. The roof may have been worth $25,000. 4 years later, you replace it for $35,000. Normally, your tax software just adds a new roof and you keep depreciating that old one. But if you do a PAD, or partial asset disposition, you write off that remaining $20,000 of that old roof now in that year and start depreciating the new one. This isn't a loophole. It's literally written in the Treasury regulations. And the problem is most tax pros never use it. Imagine paying taxes on a roof that doesn't exist or that's been in the garbage for 5+ years. That's like paying car insurance on a car you sold 5 years ago. It sounds crazy, right? But that's exactly what's happening on thousands of tax returns every single year for real estate investors. And here's the kicker: partial asset dispositions are a use it or lose it strategy. You have to make that election on the return, on the original return. It must be timely filed tax return for the year that the replacement happens too. Once that year closes, it's gone. You can't amend it. You can't fix it with a 3115 or change of accounting. The IRS literally says this isn't a method that you can change. It's a decision you either make or you miss. Partial asset dispositions aren't sexy, but they're rich in value, and once you miss them, they're gone forever. But here's how you do it right. To do a partial asset disposition, here's what you need to do every time you replace a major component that's being capitalized. First, you want to identify the cost of the new asset. That's easy. Check your invoice. Second, you want to determine the original cost of the old asset. If you have a cost segregation study, that's perfect. If not, use the producer price index to roll back what that component would have cost when you bought it. Fourth, you want to calculate the accumulated depreciation on that piece. Fifth, you want to write off the remaining basis. That's your partial asset disposition. And then six, you want to adjust your building's basis to remove that old component. When you do this right, it's not aggressive. It's actually technically the accurate way to do it, and you're aligning your books with reality. Old assets are gone and new ones are added. And it matters really over the lifetime of investing, because most tax strategies are 1 year done, but partial asset dispositions are slowly compounding wealth moves. And over a 30-year career, every roof, HVAC, plumbing replacement you account for properly adds up to tens, sometimes hundreds of thousands of dollars saved. And if you combine partial asset dispositions with cost segregation studies and bonus depreciation, that's where the magic happens. You can take a partial asset disposition for the old component and then bonus depreciate the new qualified pieces. And that's how you double dip legally and strategically. So let's go over a case study where someone had a new roof and an HVAC. We worked with another investor couple, and they had replaced both the HVAC systems in their duplexes for $26,000. Their old CPA didn't ask a single question. We did though, and we found $15,000 of remaining basis to write off through the partial asset disposition. Then you add in a cost segregation study on the new units, and they were able to bonus depreciate and saved $9,000 in taxes in that 1 year. That's a down payment, or part of their down payment for a new property, just from understanding one line of the tax code. Before you file your return, ask your advisor one simple question: did we replace anything this year? That question alone can save you thousands of dollars. Now, if you missed a partial asset disposition, you want to clean it up to avoid the recapture, but don't panic. You can't go back and claim it, but you can clean it up from your depreciation schedule once it's fully depreciated. That way, it doesn't give you a new deduction, but it prevents that double recapture later. Without the cleanup, you'll pay taxes on ghosts, literally roofs and HVACs that no longer exist. If you've got old roofs still depreciating, you're paying taxes on the ghost property. Clean it up before you sell. This is what real wealth planning looks like, not chasing loopholes, but aligning your money, your assets, and strategy with intention. Partial asset dispositions, cost segregation studies, entity planning, they all work together to help you keep more of what you earn and grow what you built. Wealth planning isn't flashy, it's intentional and focused. You don't need to outsmart the IRS, you just need to follow the rules and be organized about it. So if you own rentals and you've replaced anything in the past year, roofs, HVACs, flooring, plumbing, your next step is simple. Go to bristertaxlaw.com, book a tax strategy review call today. We'll review your depreciation schedule, identify missed partial asset dispositions, and make sure that your 2024 tax return captures every dollar that you deserve. Don't wait until next year to realize what you've missed, because once that year closes, you can't fix it. You don't wait. The partial asset dispositions expire fast, and you've worked too hard to build wealth just to lose it through missed elections or lazy accountings. Partial asset dispositions aren't about loopholes. They're about being technically correct and precise. Thanks for watching today. If you found this helpful, go ahead and give it a thumbs up, drop a comment below. If you have any questions or thoughts, I always try to respond. And if you haven't already, hit that subscribe button below, ring the bell so you don't miss the next video. And if you want to go deeper or grab the resources mentioned, check out the description below. I've included the links, tools, and next steps for you there. And if you're ready to talk through your specific situation, you can always schedule a free discovery call using the link in the description. Just pick a time that works best for you. Thanks.